The Reddit army appears to have a new target.
GameStop.
GameStop.
This GameStop situation is the craziest I think I've ever seen.
So if there's one thing we've learned from the battle between retail traders on Reddit and hedge funds like Melvin Capital and Citadel, it is that regulators are real quick to respond when average folks are making serious money. Because the Secretary of the Treasury, Yellen, pulled a Drake on retail traders and went 0 to 100 real fucking quick by demonizing the short squeeze on GameStop that was making these traders millions. The success of these Reddit traders was definitely pissing off Wall Street in a big way.
Fundamentals, they don't even know how to spell it, let alone define it.
Now these retail traders were not hurting the economy, nor were they conning or scamming people. They were just discussing stocks and trading strategies in an open forum for everyone to see. But somehow Yellen felt that what the Reddit traders were doing was so detrimental to the financial system that she assembled the so-called Dream Team, consisting of the famously slow and ineffective SEC, the let's just wait until there's no other options Federal Reserve, and the ever so sleepy CFTC. Now could this swift call to action perhaps have something to do with the fact that Yellen was paid over $7 million in just 2 years to give speeches to banks and Wall Street investors? Yellen even received over $800,000 from Citadel, the very same company that lost big due to the Reddit traders short squeeze, and now she is in charge of the investigation. So no conflict of interest at all, right? Now to put this into perspective of just how crazy fast the response from all these agencies was, take a look at the biggest Ponzi scheme ever created by the one and only Bernie Madoff, who created a $65 billion Ponzi scheme, and the SEC never acted on the multiple complaints from industry insiders. Not even when one whistleblower laid out the entire case perfectly and all they had to do was go out and arrest him. So this makes you wonder, what is so special about Reddit traders making some money from the stock market? Perhaps it had something to do with the fact that the evil 9-to-5 working man, and woman of course, were bullying the sweet and innocent little billion-dollar hedge funds that had no way to defend themselves. I mean, it's not as if they had any expertise on how to handle complex financial situations or have any access to pre- and post-market dealings that completely exclude the retail trader from the so-called open market, right? Because that would actually be an unfair fight. Not to mention that hedge funds only have access to tens of thousands of MBA graduates from simple universities like Wharton, Yale, Harvard, while the retail traders have an unlimited supply of 70-year-old savages,
Hippos.
Hippos!
16-year-old IT assassins, and not to forget the deadly kingpins of the 9-to-5.
You said that we could come to you if we had any questions.
Sure.
Where's the clitoris?
Now all jokes aside, the question of is Reddit trading illegal, should it be legal, and is there anything malicious going down in the world of social media trading is a very fair one to ask. However, the point I'm trying to make here is that that question only got asked when average people started making millions at the expense of hedge funds. When it's the other way around, you never hear any of the regulators call for action. The initial outbursts from politicians and regulators focused mainly on the retail traders and completely disregarded the real problem, which was, how can you even short more shares than are actually available, and why are these big companies allowed to take on so much leverage and risk? Well, the funny thing is, we got an answer to that question real quick, since a couple of months later, this genius, Bill Wang, of Archaeus Capital, lost $20 billion due to over-leveraging the company and pulling in major banks like UBS and Credit Suisse. This to me seems like a much bigger problem to the integrity of the financial system, and addressing this issue would actually protect citizens. But somehow regulators still see the retail traders as the main problem. So blatant favoritism aside, what exactly is market manipulation? Well, as defined by the SEC's 49-page PowerPoint presentation, market manipulation is intentional or willful conduct designed to deceive or defraud investors by controlling or artificially affecting the price of securities, or intentional interference with the free forces of supply and demand. Now, this lengthy definition is perfectly embodied by one of the classics, Boiler Room.
We're JT Marlin. This stock is blowing up right now. The whole firm's going nuts. Hold on, let me open up the door to my office. See that, Doc?
Give me the 2,000 shares.
Done.
Sale is made.
This is what they call a pump and dump, and yes, it's very illegal. So let's compare this to Reddit trading. The first part states, conduct designed to deceive. Did the Reddit community try to deceive people by talking about the GameStop short squeeze? No, not at all. The GameStop short squeeze actually started way before the international media hype, when the true legend, Dr. Michael Burry, yep, the guy from The Big Short, did his due diligence and discovered that the short interest on GameStop was way too high and that the hedge funds were at serious risk. This work was then picked up by some in the Reddit community and they expanded on his idea. These people were not just creating a pump and dump, they were legitimately identifying a flaw in a hedge fund strategy and capitalizing on it. Their reasoning was done in the open and all the data was verifiable since it was based on public sources. So where is the deceit or the defrauding here? There is none. The second part of the definition reads, by controlling or artificially affecting the price of securities, which is actually hilarious when applied to the GameStop case. Because if anyone is trying to control the price artificially, it is most definitely the hedge funds that are betting on the stock to crash. Just check out the video on Bill Ackman linked up here on how he made $2.6 billion in just 30 days while scaring the living shit out of investors on national television. How is that not the exact definition of market manipulation? This behavior has become the standard operating procedure for most CEOs and hedge fund managers. When they short a stock, hedge fund managers don't just sit back, relax and take their daily, let's say vitamins. No, they actively promote how bad the company is, go on dozens of interviews just like Bill Ackman does all the time, and even use special trading strategies to push the stock down. Hedge fund managers want guarantees, so they will make sure that the predictions come true at all costs. At the same time, retail traders have almost no control over the price of a stock because they lack the buying power and the access to certain tools to do this effectively. The only reason why traders on Reddit could influence the stock of GameStop was because the hedge funds created a giant mess. What basically happened was that hedge funds built a trapdoor for GameStop and then the Reddit traders pushed the hedge funds into it. It's that simple. The retail traders could have never done what they did if the hedge funds had not shorted the stock like maniacs. Before we continue, please like and subscribe to the channel for more videos. Now if you buy a stock when it's super cheap and then start selling it aggressively to uninformed consumers so that you can sell it when it's high, that is artificially pumping up a stock, since nobody would have bought that stock if it wasn't for your aggressive marketing and selling. But when you buy stocks that are shorted past an acceptable amount and then hold on to these, you force hedge funds to buy even more stocks to cover their short positions. This forced buying by hedge funds further increases the price of the stock. It's a simple vicious circle that only works if hedge funds make the first mistake. And don't forget, hedge funds are not uninformed innocent consumers. They know perfectly well what they're doing and they can get themselves out of trouble if they want to. In the end, it turned into a game of chicken between retail traders and hedge funds to see who would pull out first. So is the financial market now at risk? No, not really. Is the consumer then at risk? Also no, because this type of retail short squeezing is a very specific isolated incident that can only work under the right circumstances. You can't just get a group of people together and start doing this to every single stock. So now we come to the part where we have to play a bit of devil's advocate here and look at it from the regulator's perspective. These regulators basically see a group of people using something called the internet and Reddits. Don't forget, we're getting into the mind of pure dinosaurs here, because around 25 of the 100 senators are over 70, with the 3 oldest being 87 and 86. So good luck explaining NFTs to them. They're still working on iPhones.
How in the hell you can't access a phone? I just find baffling.
Now, all people jokes aside, they really see what happened as people coming together online and deciding on which stocks to pump and dump. So the question then becomes, should it be legal for people to discuss stocks in an open forum and form some kind of movement against or for a particular stock? This sort of broadens up the definition of what market manipulation is, and things always get a bit tricky when you start formulating unspecific and very broad laws. The irony of this whole call for regulation is that it actually came from the hedge funds themselves and Wall Street professionals. Even though these major players in the financial markets have been circumventing and outright breaking laws for decades, all while screaming that government should stay out of the free market. But I guess that does not apply when they are the ones losing money. Now personally, I think that discussing stocks and trading strategies online is no form of market manipulation and should be fully legal. It's the same conversation you would have with friends, colleagues, or family members over dinner. The only difference here is you're doing it with 100,000 people or more. However, with that said, you should always honestly disclose your holdings and your long-term plans with the stock, meaning pump and dump is obviously a no-go area. But letting people know there's a flaw in the system, like for instance with the 2008 subprime mortgage crisis, that should be perfectly fine. If a company is committing fraud or misleading investors and you tell everybody to short the stock, that will obviously hurt the investors who have already put money into the company. However, it's not your fault, it's the fault of the management that is defrauding these investors. Now the counter-argument could be that if you're mobilizing 100,000 people around a certain trading strategy, you are increasing your influence on that stock and you are deliberately controlling the price up or down. Well, to that I say, sure, that's true. However, as long as it's happening in an open forum for all to see, everybody can take in that information and react accordingly. if you take a simple poll amongst your 100,000 Twitter followers that says, do you think Apple is going to beat earnings next week? And 70% say yes, it could spark a buying frenzy and the shares of Apple could rise. But how is that a bad thing? If the majority of people actually think that, there's nothing wrong with this group discussion. When hedge fund managers go on various shows like CNBC or Bloomberg with audiences in the millions, they are doing the exact same thing. They discuss their trading strategy, their positions, and whether they think a company is bad and will fall to zero, or if it's a great investment and you should definitely start buying the stock. How is this any different from discussing this on Reddit or any other social media open forum? It's very hypocritical to glorify CNBC and Bloomberg, but then to demonize social media. Then there is Squawk Box and Squawk on the Street, where a young boy and an old man try to, let's just say they try to show that they know a lot, not about stocks though, but something I'm sure, feet maybe. Oh wait, that's not much better. Okay, let's just move on. Anyways, what I'm trying to say here is that either all public forms of discussion and recommendations on stocks and trading strategies should be legal, or all of them should be illegal. Don't pick and choose that CNBC recommending a stock or having a hedge fund manager come over and spew some doomsday bullshit and say that's perfectly legal, but as soon as you recommend a stock or trading strategy on Reddit, it's all of a sudden illegal and should be banished. Rules should apply to everyone across the board, not one set of rules for these traders and then a whole different set of rules for other traders. The thing that's most infuriating about this whole situation is that so many regulators keep pretending that it's all being done to protect the retail trader. They love to talk about protecting the single working mom that tries to feed her kid and pay the bills, or the cute, fragile old couple who are retired and have nothing to fall back on if they lose their savings. This is all such political bullshit because when they have the power to actually make changes to the system that helps working moms, retirees, veterans, school children, or anyone else who really needs help, they fail time and time again, and then they use filibusters, they play games, they play with people's lives, and they only serve the biggest campaign donors. The single working mom and the old retired couple are only ever used to score sympathy points. They never actually want to solve their situation, because why would they? If they do that, then who are you going to use to manipulate the market? Full circle. This was Is Reddit Trading Market Manipulation? Please like and subscribe to the channel for more videos.